Hello friends, Chris Lee CPA here, back with another video for you. And today I'm going to talk a little bit about one of the strategies that we will implement for high net worth families or younger people that have a potential for, a taxable estate. So this is to say individuals or families that have maybe assets, highly appreciating assets that maybe would result in, a net worth on your date of death of 30 million plus if you're married, 15 million plus if you're single. That becomes a taxable estate, and a taxable estate has a couple of problems with it, and so we usually want to try to work around that. So when it comes to a taxable estate, the real issue is that tax is assessed not only on the liquid assets, but also on the illiquid assets. And so when we think about that, right, like the IRS, though, is going to expect payment, liquid payments. So you have to use cash positions to be able to fund tax that is assessed not only on those liquid positions, but the value of all the assets. So that's the most challenging part when it comes to estate taxes, is that we're valuing all assets, not just the liquid assets. And so you have to make sure you have the liquidity to cover those taxes. And we also are thinking about managing the appreciation of those assets, accordingly, so that we can minimize the tax consequences. And so that's really what we're thinking about when we're trying to solve the liquidity problem. Oftentimes we'll use, certain life insurance products to solve that problem. That's where whole life, different type of whole life policies or universal life policies make a lot of sense. But whereas term life is usually what would be recommended for most people. But with that, there's a special Intentionally Defective Grantor Trust. Sometimes you'll see it abbreviated IDGT. And so this is a special type of trust that helps manage that value of that estate that would potentially be taxed. And so what we first need to do is understand a little bit about trusts in general and how they work before we can talk about how this intentionally defective grantor trust helps solve the problem that can arise from highly appreciating assets that are held by natural persons or families. So first, we need to understand that there are functionally two types of trusts. There are revocable trusts and irrevocable trusts. In the case of revocable trust, the income is typically taxed to the grantor, the person that, puts the assets into the trust. The grantor grants the assets to the trust. That is to say, the person funding the trust is going to be treated as the owner for federal and state income tax purposes. So you put the assets in there. This revocable trust, because it's revocable, you've not really changed the economics of those assets at all. And because of that nature, the IRS treats it as though you still own those assets. It's kind of functionally like a single member LLC, not for legal purposes, but for tax purposes, right? Like whatever happens inside that single member LLC, it's kind of disregarded. That's functionally what happens with revocable trusts. It's labeled a grantor trust, and then it's basically disregarded for tax purposes. That's to say, all the interest and dividends and everything that's kicked off from that trust comes back to you for income tax purposes, and it also remains with you for estate tax purposes. Really, a revocable trust helps with probate processes when you pass, but it does not solve any sort of tax problem or provide any limitation on that front. Now, there's the other type of trust, the irrevocable trust, and this is generally a taxable entity, distinct from the person that grants the assets to the trust. So when it becomes a taxable entity, that is to say, it has its own income and deductions, and it's reported on its own income tax return. It's called 1041. And so its own income and deductions has its own special treatment. Now there are special rules and elements to trust that kind of look like a partnership or an S corporation, in the sense that if it distributes income out, that it will kind of share the burden of those income tax consequences with the beneficiaries, not the grantor, the beneficiaries. And so the trust itself, though, is a taxable tax-paying entity fundamentally. So assets transferred to an irrevocable trust are generally removed from the grantor's estate for estate tax purposes. So like that's why we use irrevocable trusts, is that when you have highly appreciating assets that maybe today they're not worth a substantial amount of money, but they have potential to be highly appreciated assets on your date of death, those assets becoming part of your taxable estate increases your estate tax consequence. Again, estate tax is a tax on your net worth when you die. So when you're solving these problems, you're solving your family's multi-generational wealth problem. So we're talking very high net worth people that are having an estate tax problem. And so even though this might not be you today, it is something to think about if you find yourself in a circumstance where you might have windfall events and now all of a sudden you've got assets that might appreciate in ways that you want to solve for those problems. Now, that is whatever, kind of circling back though, irrevocable trusts, because you cannot change them very easily, you're not treated as owning them on your date of death. The trust is treated as owning them for estate tax purposes, and that's a good thing. We want to own less when we die, when we're facing estate tax problems. And so you'll take the assets with high appreciation potential, put them in the trust, and that kind of helps solve the estate tax problem. So the advantage of the intentionally defective grantor trusts becomes that it retains the character of a grantor trust for income tax purposes. And honestly, taxable trusts create more income taxes, not less income taxes. And that's because the rates on taxable trusts are much more condensed. So you get to the highest marginal tax rate much faster than you do if you're on a natural, that of a person. So the the Form 1040 form, the brackets are much spread out, so you get a little bit more rate arbitrage there. This special type of trust, the intentionally defective grantor trust, is an irrevocable trust that is a grantor trust for income tax purposes. So we get the benefit of lower income tax consequences on the income of those assets, but we will also get the estate tax benefit of those assets not being included in the taxable estate that may or may not exist. So the intentionally defective grantor trust works in establishing it. Basically, you form an irrevocable trust and have enough elements that basically make it a defective grantor. It's a defective trust. Enough language that defects it from being revocable to make it look more like a revocable trust for income tax purposes, but it's an irrevocable trust for estate tax purposes. And so it's a completed transfer of assets to the trust that really cannot be changed very easily or at all. That is what makes the function work, that it gets it out of the taxable estate. However, certain elements of the language in the underlying trust document makes it such that it defects that treatment for income tax purposes. And so again, kind of circling back to the benefits of an intentionally defective grantor trust, the grantor is responsible for paying the taxes. So this is to mean that the trust assets can appreciate without a tax drag on those assets. So the grantor does not get to take cash out of the trust to help pay for the income tax consequences of those assets in the trust. Those assets are there and they're outside the control of the grantor once they enter the trust. That is fundamentally what happens when you have an irrevocable trust. So anyway, the assets can grow without a tax drag, and the result is that more assets will pass estate tax free to the beneficiaries of the trust. So the two additional benefits is that it's, again, reducing the grantor's taxable estate in the amount equal to the income taxes paid by the grantor. And it's also helping preserve the trust by not reducing it with the trust's payment of taxes. So you get a couple different benefits in there. So how do you transfer assets so you do need an attorney to write the trust documents in such a way that you get this intentionally defective grantor trust. Usually it comes down to having substitutionary powers, which is to say that you could change out the assets within the trust, but they might. Trust is the value that will kind of be removed from the estate. You can change out the assets, but in total, you cannot just take assets out or put assets back in or change the beneficiaries in any meaningful way. Like you're really only changing the composition of the assets. You're not changing values. You're not taking benefits from it. So that's functionally what makes it the common language that's used to create an intentionally defective grantor trust. Now, how are assets transferred into these types of trusts? Well, you can do it by gift, a complete gift, partial gift, part sale, or you can just do an outright sale of the asset. So when a grantor, the person establishing the trust, makes a gift of assets to the trust, it reduces the lifetime gift and estate tax exclusion amount that everyone has available. So that's where I was talking about those thresholds earlier. If you are going to die, if you pass away and your net worth is above $15 million, which is your lifetime exclusion for gift and estate tax, that's when it becomes taxable. So when you transfer assets while you're still alive, you reduce that exclusion, right? So that exclusion is kind of a living, breathing amount. So if you transfer assets earlier, you're going to use up some of that exclusion, but you are using that exclusion on today's value of those assets rather than waiting for that exclusion to be applied in full on the appreciated assets of the taxable estate. And that is to say, you think the assets are going to appreciate faster than the estate tax exclusion will appreciate, right? So the estate tax exclusion generally indexed for inflation and kind of moves upward according to the applicable federal rate every year. So you're assuming these assets, they're going to grow faster than that, and that's why you want to get them out of your estate. So you can do that by gift, which again uses up the lifetime gift and estate tax exclusion amount. And if you go in excess of that, you would have a gift tax to be paid on that transfer. So you'd be filing your appropriate tax forms to report and pay that gift tax. So often assets are going to be partially given and then partially, done as a sale with an applicable note to leverage the amount of assets that can be transferred, but still preserving some of that exclusion. You don't really want to use it up all at once because your mix of assets might change. So you might have more assets that you're betting differently on in the future that are high appreciation potential versus others. Now, if you do a sale of assets to an intentionally defective grantor trust, this involves, the assets being sold at their fair market value in return for a note, a promissory note from the trust to the grantor that has, usually a pretty low interest rate. So the assets being sold are typically going to be, a significant potential appreciation, and the ultimate objective is to get that future value of that asset out of the estate. So since the trust is purchasing the asset at its fair market value, the grantor is not deemed as having made a taxable gift. The trust would make interest payments to the grantor on the note, and the installment note received by the grantor in return is regarded as a full and adequate consideration of the minimum interest rate, that's required to be charged by the IRS, the applicable federal rate, and then all the normal formalities. Now, that is to say, when you do sell the assets, you've got the income tax consequences of those gains and losses on the grantor's tax return. And then you've also got the interest income on the loan of those assets coming in as well. So fortunately, the interest can be, timed in such a way that hopefully it's not bumping up maybe your net investment income tax or other items. So you're going to be doing a meaningful amount of tax planning there. So the disadvantages of this intentionally defective grantor trust is that because it's an irrevocable trust, it's really hard to change or modify anything about it once it's established. And then in addition to it, you're basically making a bet that the assets placed inside the trust will appreciate faster than that lifetime exclusion is going to appreciate that lifetime exclusion that makes your estate not taxable. So that's really what you're doing. You're making a bet that the asset's going to be worth more in the future than your estate exclusion, your lifetime gift and estate exclusion can absorb and such. You're trying to solve that tax problem on the other side of it. So again, these decisions are big ones, and they are usually made in good consult of a number of people involved, accountants, lawyers, financial planners, that sort of thing. So to know if you really should be considering an intentionally defective grantor trust, you have to kind of have a good sense of where your assets are going to be heading and what you will potentially have as an estate tax consequence. The strategy is only effective if the grantor has adequate resources to continue to pay the trust's income tax liability. So you don't want to drain yourself of it, because the income from these assets is still going to be taxed to you, but you don't have access to them. And so that's something that really has to be thought about, that you've got enough cash flow from other assets to support paying taxes on those assets, your living expenses at whatever standard of living you're used to, plus the taxes of these assets that you don't get the benefit of. And so that's really an important decision. And then you're really going to be involved in qualified legal counsel, the choice of the language and the practical considerations that go into these trust documents. It's really important to make them effective. So just make sure that you're working with estate planning attorneys that are familiar and comfortable with these concepts. And if you think you ever need an attorney reference or need to talk with an accountant about that, feel free to book a call on the link in the description, and we can go from there. So back with another video for you soon. Take care. Bye-bye.